Hey everybody, welcome to the morning market briefing, Tuesday, February 14th, 2023, Valentine's Day. Don't forget, got CPI coming in, looking for a very lovely number. We'll see what happens there in just a moment. I think Tom is on the ones and twos trying to track that down. But opening up then with the Bank of America Global Fund Manager survey. Some interesting takeaways specifically. I thought the most noteworthy thing was the commentary kind of as it related to China. 66% view that as inflationary. 66% expect the US dollar to continue to fall. And 66% think the market is experiencing a bear rally. Seems to be some continuity potentially among those viewpoints, but where would you kind of describe where we are as it relates to other money managers and what they're seeing?
People are definitely more bullish, I think, out there, but you still see two standard deviations below normal in terms of equity weighting. So that means, 90 to 95% of the time, people are positioned more bullishly in terms of how many equities they hold than they are today. In terms of sectors, you still see overweights in healthcare and consumer staples, underweights in utilities and technology. You still have a relatively elevated cash position, although it's a little bit off the highs. But by and large, there's a lot more positivity about the overall economy. Whereas a few months ago, 75% of fund managers thought that we'd be going into recession right now. That's down to less than 30% now. So it's definitely more of a stagflationary feel to it, not full on growth mode. And fund managers still positioned relatively conservatively, but we're well off the conservative levels that we had even just a month ago, but especially 2 months ago. So that's how I'd characterize it. I think that what we try to do at Narwhal is be a little bit more balanced. So when people are getting very excited, we tend to be a little bit more cautious. And when people are very fearful, we tend to be a little bit more optimistic. And I think that discipline is kind of grounded in what we do on the asset allocation side. It helps keep us disciplined because we're not immune to the feelings and the emotions of the market. And so what we do is we try to keep relatively neutral and be objective about how we look at things.
Yeah, I was talking with a client yesterday about that. I think an underrated part of the asset allocation is you think of discipline maybe at surface level of just saying, oh, I'm 64% equities and Narwhal staying really tight to that. But the other thing that does is trying to hover near that number. It forces discipline and forces conviction among your ideas, because if you're overweight when you're trimming, you want to trim prudently and trim in a way that makes sense relative to conviction. Similarly, if you're adding to a position, it really kind of forces you to go where you view the best risk reward profile on an investment by investment piece. So there's kind of two layers to that discipline. It's not just the allocation. It's also kind of rebalancing to make sure that we're positioned where our conviction lies. Tom, assuming we've got the CPI number here, the headline expectation is for a reading of 6.2% year over year, which would be down from 6.5%. That would imply a month over month move of about 0.5%. What are we seeing?
So we actually came in hot. We came in at 6.4%, and the core also came in hot. The expectation there was 5.5%. It came in at 5.6%. Otherwise, month over month came in line at 0.5%. Core came in line at 0.4%. What's interesting to note, though, is that they actually, ahead of this announcement, revised based on the new calculations last month up. So instead of CPI dropping by 0.1%, their new revisions estimated it actually went up by 0.1%, and the core went up by 0.4% last month. So initially, the bond market turned red. We came in hot. Bond market didn't like that. But now we're seeing the exact opposite effect, which is the 10-year Treasury has dropped from over 370 all the way down to 360 and settled sort of somewhere in the middle. And we're getting a lot of feedback on our headsets. I'm not sure if that's internal to us or you guys can hear that in on the call here. But we're definitely ahead. But I think that the market was definitely anticipating a higher number just based on the way the bond market was moved. Initially, there was a little bit of a spike, but everything is green now just across the board. So I think everyone was really anticipating a hot number. This one wasn't as hot as they thought. It is slightly above expectations, but it's not just a blowout. So I think that we're actually seeing some positivity here.
Ben, I know you're digging into the individual numbers and specific components. But I mean, it's interesting to see the reworking of the formula in a period of, I guess, relative heightened volatility as it relates to people actually caring about inflation. Odd timing, but
yeah, I mean, I have to say, I mean, I'm not. It's an interesting number. The reason that it was down a little bit was primarily because of medical care services, which were in depreciation. So it looks like there was 0.7 of a decline, and that's all done because of the health insurance true up at the end of the year. So if you look at the month over month health insurance, you're down 3.6%, which is an annualized drop of about 50%. And that's because health insurance companies, the way they calculate that is when health insurers make a lot of money and generate a lot of profits, they back that back into the health, because basically they look at health insurance as insurance and not an actual cost that you have to pay. The actual cost of providing healthcare is the cost of the health insurance less the profit that the health insurers made. And so they made a lot of profit last year. And so they backed that out, and that resulted in the decline in health insurance costs and therefore medical services. So that's actually been persistent for the last few months. And that'll probably continue to be for at least the next couple, but then that's going to roll off, in which case then you start to need to see the shelter component of the CPI rollover, and that increased by 0.7 this last period. So those are the two big moving pieces. I also saw apparel. Apparel was up 0.8 on a month over month basis, which was higher than I would have expected. So overall, it is more sticky right now from what I'm seeing. I think that the only reason the market is up on this is because over the last week we've been pricing in a stickier number, because this is saying that inflation is going to be high for a while, and that the Fed is going to have to raise 3 more times in order to get inflation a little bit further down. So that would be my conclusion. The reason the market's not falling is because we've already priced some of this in. The futures are pricing that in. If you look at what the probabilities of interest rate hikes are going to do. So we're positioned for that now. We weren't positioned for it a week and a half ago, positioned for it now. And so it's kind of an as expected number, but it could have been a lot better.
Yeah. Any change on interest rate expectations?
I mean, very little. I looked right before the call started, and the peak is in July with 2.43 hikes, and that's bumped up to 2.49. Obviously, that can change as trading starts to filter through here this morning. But I mean, at this point, we're looking somewhere between 2 and 3 hikes by the middle of the summer, at which point we're either going to pause or probably come down. But that's what interest rates are indicating. Obviously, the Fed can continue to hike straight through that as data continues to come out. But I think that this is probably at least locking into more, maybe 3.
Yeah. Interesting. Yeah, I mean, I think it speaks to, there's some resilience there, and I think the market's priced that in. I mean, no huge shocks. I mean, in some ways you wonder, like, what would the inflation number be that would be really shocking at this point? We felt like we kind of took all that on the chin last year. So hopefully we get a little bit more calm on CPI report days, on Fed days, things like that.
I mean, one big takeaway is we're talking about, do they raise 2 more times? Do they raise 3 more times? Not do they raise 17 more times? And I guess that could be a possibility, but I think it's significantly lower probability today than it was this time last year.
Awesome. The U.S. selling more of the strategic petroleum reserves. It's 26 million barrels. This is mandated by a budget mandate enacted by Congress back in 2015. There was some degree of expectation that the Energy Department might try to push back on this, but looks like another chunk of oil coming off the board from the reserves. This would put us at the lowest inventory level since 1983.
I mean, it just doesn't make any sense when they're trying to buy SPR reserves back. So my guess is the Energy Department's going to push back on it and not go through with these sales. But it's remarkable how you have this vestige from 2015, 8 years ago, that says you have to sell. And so they're now selling on top of when they want to be buying. So, yeah, I guess we'll see what happens with that. Oil was down a little bit overnight, I think, as a result of this story.
Tom, some shakeups in central bank land. Lyle Brainerd leaving the Fed to go to Biden's Council of Economic Advisors. Also some swapping around with the Bank of Japan. Any implications from these moves?
I mean, it's definitely interesting because Lyle Brainer's been passed over twice now for big jobs by the Biden administration. I mean, Janet Yellen notably took the Treasury Secretary job, and then they kept Jay Powell as the chairman of the Fed. And it's interesting because Lyle Brainerd is essentially the coach in waiting. She's, Will Muschamp at Texas right now, waiting to take on the head coaching role at the Fed. But it looks like they're just going to go ahead and move her in-house. And I think that the move there is probably, should the Democrats stay in office, she would probably shift back, take over for Powell at the end of his tenure, and take over. But for now, they basically want her in-house. They don't want her on the Fed. Notably, she is one of the most dovish, Fed participants, so that could have an impact on the number of rate hikes going forward. But it's definitely something to keep an eye on. But it also may be a bit of a potential, having somebody on the inside that maybe has a little bit of influence as well. If she's on the council, she can then in turn perhaps influence the Fed into doing what the Biden administration wants to do in terms of economics heading into an election year.
Yeah, bringing her indoors may make sense, and put her in the office.
Yeah.
Ford cutting 3,800 jobs in Europe, a good chunk in Germany, a good chunk in the UK. This is about 11% of its workforce. The representatives from Ford saying this is paving the way to a sustainably profitable future for Ford in Europe, and it requires broad-based actions and changes in the way we develop, build, and sell Ford vehicles. Interesting move. They're trying to, go through this huge shift to battery only in Europe by 2035. Not necessarily surprising, I wouldn't say.
Frankly, I kind of forget that Ford has a European business.
It's so small.
GM left Europe a decade ago. It's just not a very profitable business because you get all the subsidies for the domestic manufacturers. So, Ford should probably just get out of Europe, but they're sticking it out.
A couple earnings reports coming through. Let's start with Integris. Earnings per share came in at 83 cents. Expectation was 78 cents. Revenue up pretty nicely at 94.61 million. Still a little bit behind what the expectation was there, but a nice year-over-year change. Margin came in a little bit light. Any big takeaways from them?
Yeah, I mean, on pro forma basis, it's only up 1% because they acquired the CMC Materials business. But it was a little bit better than expectations. There was one segment that was a little bit worse than what I was planning for. I would just bring this up because it is a vendor to a lot of semiconductor companies. It is a small, modest position for us. I think that Integris has the potential to be one of the biggest returning investments over a multi-year period. But it's going through a cyclical downturn right now. And I think the stock will probably be down a little bit today. But a lot of this was already known. We knew it was going to be a weak first half of this year. And I don't expect there to be a ton of downward revisions for the company from the sell side. In fact, there'll probably be some people defending it. So the conference call is at 10 a.m. I'm interested to hear what they say. But we also got good news out of Global Foundries this morning, which said the semiconductor market is beginning to turn. So I'm really not too worried about it, even though it's probably going to be down a little bit today.
Coca-Cola, similar themes in a lot of ways to Pepsi, seeing solid pricing mix, the return of fountain customers, or at least the recovery there. EPS came right in line with the expectation. Any big takeaways from Coke?
Moderating inflation. I know that came in a little bit hot this time. That's primarily mix related. I think they had some price in there as well. But I expect that to come down over the balance of the year, and management does too. Now, management expects moderating prices over the balance of the year. I think they do have more pricing power, but I think they're choosing not to exercise that at this point in time because I think there is a lot of inflationary fear and inflationary fatigue. And I think Coca-Cola is on the forefront of that. Plus, with Coca-Cola, you do have some optionality there. They're announcing this rum and Coke all in a bottle. They started that in Mexico, and now they're going to be launching it here in the United States. See how that goes. And once they do that, then they have a lot of growth opportunities within that kind of seltzery mixed drink in a can.
Sugary cocktail.
Yeah, the question is, do people still drink and Cokes?
rum and Coke is such a trash drink.
Like rum and Coke, Jack and Coke, like those were like high end cocktails in 2002. But like, are people? I mean, maybe they are, but I just feel like people don't like roll into a bar and be like, "Yeah, let me get a rum and Coke."
Excuse me, it is.
or
Sorry,
Crown and Coke.
you're right. It's Jack and Coke. It's not rum and Coke. With
But
it.
even so,
Same
like,
thing.
yeah, it's
Same.
like man, like they could have striking when the iron was hot. One that was like a good 22 years ago.
Yeah, when I was in college, so this would have been, like 15 years ago, there was a bar that had an icy machine that made frozen Jack and Cokes. And it was the most innovative thing 21-year-old kids had ever seen. Never anybody under 21. But I just feel like they maybe missed the peak on that.
Yeah, drinking Jack and Coke is going to be like we didn't know cigarettes were bad. They're like, oh, if you just put a Coke, just straight alcohol in it, like that's not good for you. Like,
It doesn't even taste
it
good.
might make you sick.
Getting some movement on futures up quite a bit now. S&P futures up a little bit more than 1%. They've been bouncing a little bit between that kind of 0.5% range and 1.1. When we started the call, they were up about 20 basis points. So kind of interesting there. We'll wrap it up there. We'll be back tomorrow morning at 8:30. Hope you guys have a great day. Talk to you soon.